Greetings, have a seat and listen up. Go ahead, smash that like button. Subscribe, because your journey to financial freedom starts here. Investigation Investment TV.
The world of investing can be a confusing one, especially for those just starting out. Between complex jargon and conflicting advice, it's easy to feel overwhelmed and discouraged. But often, the biggest hurdle to successful investing isn't the market itself, but the myths and nonsense surrounding it. Today's video will debunk some of the most common investment myths so you can gain financial freedom and independence using the stock market. Myth number 1. You need a lot of money to invest. This myth is a major roadblock for many potential investors. The truth is, you can get started with even a small amount of money. Think of it like building a muscle. Consistent effort, not a massive starting weight, leads to long-term growth. Here is an example. Imagine Sarah, a recent college graduate with a limited budget. She decides to invest $50 bi-weekly, $100 a month, into a low-cost index fund. Over 20 years, with a conservative 7% average annual return, Sarah's investment could grow to over $130,000 total. $100 a month for 20 years would give you $24,000 in principal. That is $106,000 in gains. That 7% goes a long ways. This example demonstrates the magic of compound interest and the value of starting early, even with limited funds. Take action. Many investment platforms allow for automatic deposits, making consistent investing effortless. Start with a small, manageable amount and gradually increase your contributions as your income grows. Myth number 2, investing is like gambling. While both involve some element of risk, investing is not the same as gambling at a casino. Investing involves research, strategy, and diversification to manage risk, whereas gambling relies solely on chance. Risk is inherent in any investment, but it's not about blind guessing. Risk tolerance refers to your comfort level with potential losses. Younger investors typically have a longer time horizon, allowing them to tolerate higher risk with the potential for greater rewards. As you approach retirement, prioritizing capital preservation through lower risk investments becomes more important. In the end, you always choose what risks are tolerable to you. Imagine John, a young professional with a high risk tolerance. He invests a portion of his portfolio in stocks, which offer the potential for significant growth but can also experience short-term fluctuations. John understands this risk and has a long investment horizon. Historically, the stock market goes up over longer time frames. Regardless of the short-term ups and downs, assess your risk tolerance by considering your age, financial goals, and overall comfort level with potential losses. Many online resources can help you determine your risk profile. Principal.com has a great tool for this. It is the only thing they have that I like. Myth number 3, timing the market is the key to success. The allure of buying low and selling high is undeniable. However, consistently predicting short-term market movements is nearly impossible, even for seasoned professionals. Trying to time the market can lead to impulsive decisions and missed opportunities. Successful investing focuses on a long-term perspective. History shows that the stock market, despite experiencing periods of volatility, has always trended upwards when you zoom out far enough. Imagine Maria, who gets caught up in the frenzy of a market downturn and sells all her investments in fear of further losses. Unfortunately, the market rebounds shortly after, leaving Maria missing out on all her gains. Develop a long-term investment strategy and stick to it. Don't let short-term market fluctuations or emotions dictate your decisions. Do your research and know what's going on in the market, and with the companies you own stock in. Myth number 4, you need a financial advisor for all investments. Financial advisors can offer valuable guidance and expertise, especially for complex financial situations. However, they aren't a necessity for everyone. Many resources and tools are available for DIY investors to build well-diversified portfolios. Fidelity has a great website and phone app. I highly recommend them for DIY investors. Also, financial advisors can charge very hefty fees at times. Unless you have an overly complicated financial situation or huge sums of money to invest, then a financial planner's fees will eat up a huge percentage of your gains. Robo-advisors provide automated investment management based on your goals and risk tolerance. Low-cost index funds offer a great way to make your money work for you in a mostly hands-off way. Also, if you like to learn new things, There are numerous websites, articles, books, podcasts, blogs, etc. that can teach you everything you need to know to pick stocks as well as any pro. David, a professional, decides to use a robo-advisor to manage a portion of his portfolio. He researches different options, chooses one aligned with his investment goals, and gets a 12% compounded return from professional management without the high fees of a traditional advisor. Research different investment options and choose a strategy that aligns with your comfort level and financial goals. If you decide to work with a financial advisor, ensure they are a fiduciary, legally obligated to act in your best interest, and be sure you completely understand all the fees associated with their services. Myth number 5, past performance guarantees future returns. Past performance is certainly a valuable indicator, but it doesn't guarantee future results. Market conditions can change rapidly, and an investment that performed well historically may not replicate that success in the future. Focus on diversification. Diversification is the cornerstone of a sound investment strategy. It will help smooth out the ups and downs of individual sectors or companies. Don't put all your eggs in one basket. Spread your investments across different asset classes like stocks, bonds, and real estate. This approach helps mitigate risk, as fluctuations in one asset class may be offset by gains in another. Imagine Lisa, who invests all her savings into a single tech stock that has skyrocketed in recent years. Unfortunately, the tech company's competitor released a product that people like better, crashing her company's share price, causing Lisa's portfolio to suffer very significant losses. Had she diversified her investments, the impact of this downturn would have been lessened. Build a diversified portfolio that aligns with your risk tolerance and investment goals. Utilize online tools and resources to research different asset classes and investment options. Fidelity, Yahoo Finance, Google Finance, and Investopedia are just a couple that I use. Find the ones you like. The information is out there. By debunking these common myths, I hope you can approach investing with a clear head and realistic expectations. Remember, investing isn't some huge mystery that can only be done by professionals. With just a little effort, you can do it just as well, if not better. Arm yourself with knowledge. The information is out there. You can do this. Investigation Investment. Your path to financial freedom is just a step away. What will you do with financial independence?